If a tree falls in the woods, will your grandchildren get rich? Or something like that. Welcome back to the Banking Bros podcast, where we break down the strategies, tools, and mindsets you need to build wealth, secure your future, and leave a legacy that lasts generations. I'm your host, Jay Do.
And I'm Jonah Do.
And today we're diving into a concept that is timeless as it is powerful. Okay, here we go. Jonah, when we get into Becoming Your Own Banker, the 5th edition, the guidebook on how to do this whole concept that sparked us into launching the Save and Spend system.
That's right.
Nelson Nash, the author, talks about forestry.
He does.
What? I didn't know what that was about.
Yeah, it's not my strong suit. Didn't study that one in school.
Not at all. Imagine this, a forest that never stops growing, ladies and gentlemen, never stops producing and produces for every generation that tends to it. Now, what if I told you the same principles used to manage that forest can be applied to finances? That's right. I had no idea what he was talking about. But today we're going to explore how the idea of an even distribution of age classes in forestry can teach us about building wealth and generational tools through the infinite banking concept for your fam.
Yeah, so by the end of this episode, you'll understand how life insurance can be used as a tool to create self-sustaining, tax-free wealth-building systems that benefit not just you, but benefit your children, your grandchildren, and beyond. So whether you're looking to secure your retirement, right? Nail that down. Some people, of course, are looking to fund major life expenses. They got the big purchases coming up. Or, of course, there are those folks out there like myself, didn't think about it much before, but I sure do now, leaving a lasting legacy. This strategy has the potential to transform the way you think about money. So my 2 cents for this episode is grab a notebook, settle in, let's get started. Because today we're planting seeds for a financial forest that will thrive for generations to come.
Speaking of those generations, let's go to the good book, Proverbs 13:22. A good man leaves an inheritance for his children's children.
That's what it says.
That's what it says. Okay, so you have children at this point, so do I, of course. How old will you be when you have children's children, you think?
Yeah, so I mean, I guess we could probably Google this. I did not before the episode, but I probably would think that Google will tell me that the average age for someone to have their first child is probably between 20 and 30. And so if my kids are between 20 and 30, that means I am pushing 60.
I didn't ask about Google. You have a son. How old are you? When is he having kids? How old will you be? You won't be 60. No
That's
way.
What I'm saying.
No chance. You have great grandchildren by 60.
No, I do not think so.
100%.
50, okay? I'll be 50.
So first off, your son is 7. Yes. Okay. He could potentially have a kid in 10 years.
Yeah, probably.
Probably not.
Again, the average probably says 20 to 30.
I'll give him 15 more years. 15 years.
I'm probably 50 to 60. That's when I have kids. I mean, I didn't realize you were asking as soon as I have the first child and they're 1 day old. I'm saying I'm 50
2 weeks
or 60,
old because,
I've got grandkids.
Of course, you can get whole life insurance, the kind we're talking about, on a child as soon as they have a social security number.
That's
so
right.
They need to be about 2 weeks old and have a social. So 15 years. I'm going to give it 15 years. So you will be 47.
When I first have a child, sure.
Grandchild.
And 50 or 60 when I've got grandkids.
All right. So our grandmother, I'm the oldest in our family.
Yep.
And on mom's side. And our grandmother was 42. I'm going to give you 5 extra years.
Okay.
Yeah. Okay, ladies and gentlemen, so when you're looking at the textbook, Becoming Your Own Banker from R. Nelson Nash, 5th edition is what we highly suggest. We are taking a lot of this information from the section that is an even distribution of age classes, and that starts on page 71.
Yep.
71. Okay, so here's the idea that I did not understand, because I'd never been around forests, is that the even distribution of age classes is you take a big chunk of land and you plant trees per year. So there's always a rotation.
Yeah.
Think of it as a school. Maybe that's what it is. You got 12th graders moving on, and then you got the folks in the 11th year, and then they move to 12th and whatever, and you're just kind of moving it through. So there's always provisions for the generation that needs to use it.
Yeah, I think
cut them down.
I think the idea is you plant them in different sections, right? So maybe think of a grid if that's helpful to you, who you're listening. You've got a big square of land. Again, I know land's not always squares, but imagine it this way. You got a big square of land. You chop the square up into sections, maybe 10 sections, 20 sections, 30 sections, 40 sections. And then what you do is you cut down a certain section each and every year, and you just kind of rotate through these sections. And so what happens is by the time that you get all the way through the sections and you're back to section number one, maybe it's been 20 or 30 years. And so section number one regrew.
Yeah.
Right? It's big again. You cut it down. It provides everything that you needed. Again, in forestry, it's just not my area, so I don't know. Are they making paper? Like, why did you need them?
Well, you got to have lumber.
Sure.
Just call it lumber because that gets used for lots of stuff.
Yeah, lumber. And then, your section one grew again. The last time that I was in section one cutting things down was 40 years ago.
Right.
So what that means is section one was big and grown and flourishing again when I cut it down. And next year when I make it to section two, it'll be the same time frame. It'll be 40 years again since we were in section two. And so if you do your land like that in the forestry example, it provides for generation after generation after generation. You just have to follow the system. Right. You got to follow the plan that was put in place. And I think that's one of the most important lessons that we can learn. Like somebody way back when set the system up and said, here are the rules to make sure, here is the system to follow, here are the procedures to make sure that you never go without lumber.
Yeah. I love that.
If you mess that up,
then you're screwed.
Right.
You're lumberless, ladies and gents. So Nelson Nash was trained in forestry, the University of Georgia, I think. Maybe he graduated in 52.
Yep.
I think we just heard that coming off of the NNI annual think tank, the Nelson Nash Institute think tank annual gathering. And so he was able to put this example and spread it out for us in the book. Maybe that's why he understood and was able to develop the infinite banking concept, because he just understood it in terms of some things that happened in the natural world, like the forest.
Like the forests.
In your family, ladies and gentlemen, let's get into it. You can create a perpetual wealth building system as well, because your current generation, wherever you are, see, we're both dads here, but maybe you're a grandparent, can not only try to solve your own problems for eliminating outside third-party banking institutions, but having your own, but also developing a wealth generation system through these policies. These contracts don't have to just be bought on you, but can be bought on your family members. So you as an owner may own life insurance on another insured body.
That's right.
Maybe it's your spouse, plus one. Maybe it's your children or your children's children. So in this section of the book, page 71, Nelson talks about what it looks like if grandma and grandpa start policies on the grandkids.
That's right.
So let's assume that we have a couple of generations of policies at this point. At least everyone owns them on themselves. Mm-hmm. So you and the plus one own one. You've got the kids that are now parents.
That's right.
And then you buy them on these new grandkids when you're 47. So here's the question, Jonah. Help everybody understand what happens as you roll off of the grid, move on to the next life. As Nelson would have said, graduate.
That's right.
Graduate into the next life. Now your policies mature, but the other generations have policies. So help us out. You own policies on the grandkids. You're dead now. What's going on? You've got policies. You own policies on other people. Tell us how it works and explain it to the people.
Yeah, so the general idea here is when I purchase the life insurance on myself, I'm the insured body. Eventually and typically, I'm going to graduate, expire before my children or grandchildren will, right?
Hopefully.
And so the way that life insurance is designed and set up to work is that when I pass away, there is a big death benefit that is going to pass to some one somewhere, wherever I assign it.
Yeah.
So if my idea here is like the forest example, to make sure that my family, I can put it in layman's term, right? I want to make sure my family eats and has the ability to eat and has wealth coming to them always.
Right.
What I want to do is I want to set up the policy on me that when I expire, graduate, move on, that the death benefit is now paid to the children.
Yep.
And the children, of course, have areas to put the money. That's important. We want them to be able to fund their own life insurance policies with it, pay back their life insurance policies that they've been using for houses and cars and their lifestyle, right? And then we've got to keep the generation going. We got to keep the process going, very similar to the forestry example. So what we want to do is we want to make sure the grandkids have policies. And anytime there's a new generation, you just always want to make sure that there's a policy in place for a few reasons. One, the policies last longer, right? If you can start these policies on children, they get to last a really, really, really long time. And the second reason, of course, is because we need places to put the money when the oldest generation passes away.
I love it.
And that's really important.
So now here's another thing that gets brought up in the book a lot. And I think in reality, when we're talking to potential clients and they're going through a free consultation call with us and they're thinking about this wealth generation tool, maybe they're not thinking about getting out of debt right now. They're thinking about the wealth generation tool and how do I get them set up? And I'm getting older and maybe the cost is prohibitive in my mind, or maybe I'm not as healthy as I used to be. Is you also potentially own, as the grandparent, the policy on the grandchildren for a couple of reasons. One, you may have the means that the parents, your children, generation 2,
just
does
don't
not have.
Yeah, sure.
Right? They're in that place where we are. We're out here with our kids fighting fires with these kids every day.
Working hard, making active income right now while the kids are young and in the house, because we have to spend a significant amount of the income that we make on kid expenses and life in general, right? I think, again, I should have maybe done some Googling before we started the episode, but I'm pretty positive that this stage that we are in both of our lives is like one of the most expensive stages.
Yeah.
Like this 10 to 15 year mark is like where you have to spend the most money. You have to make the most, you have to spend the most because of, again, life, but a lot of it is because of where the kids are and what the kids need.
Actually, a couple of years ago, I saw that because prior to your children getting to school age, where at that point, most people send them off to government-sponsored schools.
Yep.
Before that, the previous 4 or 5 years, you got childcare. And childcare is outrageous. Everyone knows this.
Yeah, everyone.
So yes, you're probably paying mortgage. You're probably having larger cars because you got to put the kids in the back. And you may have childcare because many people have multiple children just like us. So one, you own them on the grandchildren. You're paying for them as a grandparent. So Jonah, you just said a minute ago, you have now expired, retired, died, and graduated. So where does the ownership go? The grandkid, is still alive, who's paying for this now.
So again, depending on their age, but a lot of times you're going to pass the ownership directly to the parent now. The parent's going to be the owner. And depending on how old again, if you want to follow the system, I guess I should answer the question like that. We talked about this forestry example at the beginning of the episode here, where you've got to follow the procedure. So in order to follow the procedure appropriately, the ownership then is going to pass to the parent, right? As soon as you expire or graduate. You can set all that up. A lot of people don't realize that. You can set all that up front when you're starting your policy. It's called a contingent owner. Who's the owner if you pass away? And so the insurance company even will do all of this transferring and paperwork for you. You don't even have to do it.
No probate.
Right? As soon as you pass away, now your policy's owned by your child, their parent, because you purchased it on the grandchildren.
Now remember, also, before I was trying to tie it together for you, is as the grandparent, as you pass on, and you go Hakuna Matata, wherever, circle of life, you move on, your death benefit proceeds pass on as well to your children, who are now the second generation parent.
That's right.
So they have the money and the means to keep the policy going on the grandbabies. You see how this works, everybody? It is a perpetual wealth system for your family. And now, like Jonah said, you've got these policies that are ever growing and cash flowing already started on a generation who does not even understand the financial systems of the family, doesn't understand the stock market, is not even working at this point, and their system is growing for them.
Yep.
By the time they reach that generational age where they can have kids, let's say 22 or so, I think that's what the age is in the book. He even says that. At that point, they're working on their first deals in business. They're buying homes. They're paying off college loans. At that point, when they're now in the workforce, they have a banking system that lets them, which precludes, I believe that's the word, precludes them from having to go to Wells Fargo.
That's right. So the book, Becoming Your Own Banker, the 5th edition we've got here on the table, tells of an example in the book specifically. If you've read the example or you're familiar with this is on page 71 of the book, but I think that it's worth it to go through the example for those of you who have not read it recently or have not read the book at all who are just listening. So again, page 71 of Becoming Your Own Banker by R. Nelson Nash, but it talks about this life insurance example here, and it's talking about an elderly couple who decide to take out life insurance policies on the grandkids. It actually even gives figures. Now, the figures are not super important because if you've got the means to do more or better, then your system will do more or better. And if you've got the means to do the same, awesome. And if you've got the means to do a little bit less, that's okay too. It's about the system, right? But in the book, it does give some examples. It talks about the grandparents putting $2,000 a year into a life insurance policy. Now, again, this book was also conceptualized a few decades ago. So you've got to kind of put that in today's terms as well. But that's what the book says. $2,000 a year into this life insurance policy for their 4 grandchildren, 2 boys, 2 girls. The policies were structured, just like Jeremiah was talking about earlier, so that the grandparents actually retained ownership until the grandparents would go. And at that point, the ownership would then transfer to the kids. Not the grandkids, to the kids, to the parents, right?
Yeah.
So the primary focus, of course, of the system is to build cash value over time, not really talking about the death benefit. That confuses people sometimes. You talk about life insurance enough and they just can't get that death benefit idea out of their head. But the primary focus here is to build cash value, which of course is what infinite banking is all about, right? So not only do you have the cash value growth that's guaranteed inside the policy, we talk about that a lot, but of course you've also got the dividend growth from these mutual companies that we choose to use. A lot of these companies have been doing that for a very, very long time, over 100 years or 150 years. And here's what happens. In the book, it gives specific examples. Look at when the grandchild turns 18, turns 20, turns 22, when they want to buy that first house or car, right? And it literally gives a breakdown of exactly how much cash value, how much cash flow is available in these grandchildren's lives. And I think that is a huge deal because as you read the book, honestly, right? I think literally it says like at age 22, they've got $100,000 in cash value. And at age 70, they are up to $4 million in cash value and all sorts of cool things like that. But the thing about it that always stood out to me is as you read this, I mean, think back to when you're 22.
Yep.
Anywhere close to $100,000 in liquid, accessible, tax-free cash, like anywhere close.
I graduated college at 22. I got my first installment for repaying off my loan.
Yep.
It was $322, and that was my life savings. Correct. We've had podcasts about that actual moment, that come to Jesus moment I had when that was my net worth.
Yeah, I think that I've...
my net worth was negative. That was my cash.
Yeah. I think I've the price is wrong for that one, right?
The price is wrong.
Anyway, but does that make sense? When I read these numbers, I go $100,000 at age 22. Now, again, you might be listening to this episode and you might be going, oh, that's chump change. I had that. For whatever your parents have set you up with or whatever you accomplished in your own personal life. But for the vast majority of us, $100,000 at age 22 would legitimately have been life-changing. Legitimately, this means I don't have to go work at the restaurant, be a janitor, do whatever, because I had cash value that I could now choose what actually I wanted to do, right? Mm-hmm. Maybe that gap year that everybody wants to take now, I actually used the gap year to figure out what I actually wanted to do because I had the money to fund the 1 year. So does that make sense?
Yeah.
And I think that's like
you lost me as soon as you called me out because I was that janitor.
Well, I'm just saying. But I think that's such a big deal because, man, I mean, if I can give my grandchildren that opportunity, I mean, that's exactly the verse that you read and the legacy building that people talk about. And that's what I'm saying I want to do. And the crazy part about it, $100,000 is not like this humongous sum. It's a big sum of money.
Sure.
But it's not this humongous sum. Have you ever thought about that? I've thought about that sometimes. I go, what amount of money do I actually need that I really think would like change the way that I think and approach the world?
Billions.
Right? And I mean, sure, everybody wants $1 million or $1 billion, but sometimes I really think about it and I go, you know what, if I had right now, today, an extra X, $60,000, $70,000, $100,000, that actually that gets me out of this problem and trouble that I think I'm in. It corrects the situation. Like, that's it. I need 70 grand. That's
knowing
what I need.
what we know now and doing what we would do with that, let's say 6 figures, $100,000. Yeah, it completely changes things. So keep that in mind, ladies and gents. All right, let's talk about the advantages of this system here, and we'll break them down piece by piece. In the book, they have this, and we've listed out 6 of them for you as we get to the close of this episode. But we want to remind you, ladies and gentlemen, if the wealth class, the distribution of age classes of your wealth building and your family and your financial contracts is a part of your next steps, we would love to chat with you very soon on a free cash consultation call, which you can get to by linking somewhere in the bio, depending on which platform you like to enjoy us from. We are going to have one of our coaches, Jonah or I, or several other people who actually practice this and are putting this in place for our families, walk and talk you through your situation. Your situation may have a different number of people, may have a different number for the premium. It may have a different age consideration. All of those things are what we're going to customize for you in your contracts so you have a perpetual wealth system as well. Jonah, here we go. Number 1 of the advantages of this system is generational wealth creation. Tell us about that.
Yeah, so I think that happens a lot of times a little bit automatically. Now you can supercharge this with infinite banking, but general wealth creation happens really automatically with life insurance, right? When you have life insurance policies, whole life insurance policies that you know you're going to get the check to one day, this is very different from term life insurance policies, where if you were to Google that and say, how often do these term policies actually pay out, it'll tell you 2 or 3%. Is how often the people actually get checks from these term policies, not because insurance companies don't pay, but because insurance companies are smart enough not to offer you term insurance when they actually think you're going to pass away.
Right.
So 1, whole life insurance. So that way I know my family's going to get a check one day. And if I set this up appropriately where I'm insured and I'm passing the check on to my children, or my children are insured and they're passing the check on to their grandchildren, it creates generational wealth, especially as you get these big chunks of money and you start new life insurance policies and make sure that the generation that you're leaving behind is always going to have a little bit more than you had.
Love it.
Right?
Now, I think about this from time to time. The policies that I have on my own children and you have on your own children, it's likely that they won't pay out. They will be there one day, 100 years from now.
That's right.
These policies are going to be in place and they might be passing away in 100 years. I'll be long gone by that point. But the dollars that I've put into our system now for my children will actually pay out when their grandchildren are around.
That's right.
So that's children's children.
Yep.
You remember in Hook, I will be on the doorstep of your children's children.
Peter! I swear to you, wherever you go, wherever you are, I vow there will always be daggers. They will be flung at the doors of your children's children. Do you hear me?
Do not remember that line from Hook. One of my favorite lines from Hook is, he's so deep, he's almost unfathomable. This is one of my favorite lines from Hook.
I love that. Okay, Number 2 of 6, tax-free cash value growth. Tell us all the things.
Yeah, so again, this is confusing for the first timer. If you've been around a little bit, this should not be confusing for you. But the policy grows your cash value tax-free, which of course is a significant advantage over any other wealth building tool that is subject to capital gains tax or income tax or whatever other form of taxation estate that they're going to make up tomorrow, right? Or that they're going to become more prevalent tomorrow because they changed a rule. And now I didn't have to pay taxes unless I had $1 million, but now I have to pay them on 100,000, right?
Yeah.
And so that is a humongous deal. I do not know about you, but a lot of people get on the internet and they get on social and they talk about tax deferment and they talk about tax whatever. What's the other word I want? Tax deferment, and they talk about tax advantages and tax
consideration.
Yeah, they all these tax things, and I don't. If they don't say tax free.
Yeah,
I'm a lot of times I'm like, ooh, I don't know about that one.
Now let's put a disclaimer on that one just in case, Jonah, for the long form podcast. Okay. Number one is your cash value actually grows tax deferred, but you can get to it tax free.
Yep.
Cash value is just a number in a ledger in a life insurance company. So if you call them, you can turn cash value, a number, kind of like your equity in a house. It's just a number. You can turn it into money in your pocket.
That's right.
When you turn it into money in your pocket, it is tax free. So when you borrow against your policy is what we're talking about. It will be tax-free. It grows tax-deferred because in the event you actually mech your policy, which we don't suggest and we don't set people up for, or number two, you let your policy lapse and you surrender your policy, it can be taxable. We're not suggesting that at all.
There you go.
Very good. There's your disclaimer. All right, number three, it is self-sustaining. We talked about this a lot.
Yep.
Remind us.
Yeah, so after a certain period of time, every policy is just a tad different on that. And the reason for that is because you're a tad different than the last person who got started. But after a certain amount of time, your policy can absolutely become self-sustaining. There's a couple different ways it can become self-sustaining. One of the very most common ones that you'll hear talked about, even by traditional life insurance agents, is that your dividend will do this for you. So they'll say your dividend will actually get big enough that your policy becomes completely self-sustaining, meaning the dividend can pay the premiums. So they're not saying you don't pay premiums. They're saying you don't pay premiums out of your pocket.
There you go.
The dividend's going to pay the premiums for you. So that's the thing. Your policy can also become big enough that your cash value can make your policy self-sustaining. Mm-hmm. So again, this is not premiums aren't paid. This is your cash value's big enough that your cash value pays the premiums for you, right? And then, of course, there's other options too. There's a couple different ways your policy can become self-sustaining. There are options where you can pay up your policy. You can set that up in the beginning.
Right.
So after a certain amount of time, maybe 10 years, 20 years, whatever
when you turn 65 or 70.
Whatever you need, that your policy says, all right, no more premium payments. It's now, I would consider that self-sustaining. Right. And if you didn't pick a age or time frame and you get into a situation where you just need to stop paying, you can actually turn your policy off, like the premiums off, and it can become self-sustaining. So those are the four kind of main ones that people talk about all the time, but regardless, your policy can absolutely become self-sustaining.
Let me take this one. Number 4 of 6, stewardship and financial education. What's great about this opportunity is this is where you learn that whole forestry example in your personal life. You learn to tend your own flocks. There's another verse for you.
Yep.
And you're able to pass that information on to your family members. What if your family around the dinner table once a week or once a month as you were coming up were able to chat about how to utilize the family system to keep the wealth in the family? I've had plenty of conversations with people whose family members and friends helped them fill out paperwork and then were excited about having to pay loans and interest to third parties. The money was leaving their family. But inside this system, the save and spend system, utilizing IBC, that education stays in your family, and we learn how to manage the money so we don't lose it anymore.
That's right.
Number 5, Jonah, no external risks. Tell us about those outside factors.
This one's pretty easy. So you know all of the products that have these external risks. So I'll name a few. We've got stocks, we've got bonds, we've got real estate investments, things like that. Life insurance policies are just immune to those things. You don't have to worry about crashes, market risks, natural disasters, whatever else in the world can adjust these stocks and bonds and make them start jumping all over the place. You're just not going to have it in life insurance. So what that means is it makes life insurance a highly, highly stable way to grow your wealth over time. And that's really important.
And the last one, simplified estate planning. Remember that policies pass on to the next generation, the beneficiaries, whoever you may name. You can name 1, you can name 10. It passes on without probate.
That's really important.
Yes, there's so many people out there who have had to deal with unwinding, unraveling, paying bills or whatever for some deceased member of the family and all the things that go on. Remember, these checks just show up in the mail. No more GoFundMes, no more fish fries. After the amen and the graveside service, you go ahead and eat lunch first, but then you call that life insurance company and you get the estate planning check sent right to your doorstep. Income tax-free, as we mentioned before. So those are several of the advantages of this system, and we remind you to grab your copy or crack it open, page 71, version 5, or Becoming Your Own Banker from R. Nelson Nash, to understand a distribution of age classes for you and yours.
Before we jump out of the episode, we do want to give a quick shout out to our fan follow of the week. And that fan follow goes by the name of Robert Painter. He is a YouTube subscriber to our channel. He's recently subscribed to us, so we really do appreciate that, Robert. Like always, if you've heard it once, you've heard it 1,000 times, right? What Robert should do, what you should do, listening to the episode or watching on YouTube, is leave us a question in the comments. Because what we'll do is go into those comments and answer your question. Or if you like us to, we might talk about your question on a future episode of the Banking Bros podcast. So thank you so much for following, for subscribing, for anything that you're doing to keep along with our infinite banking journey. We really do appreciate you.
And that's a wrap for today's episode of the Banking Bros podcast. We've taken a deep dive into the fascinating connection between forestry management, something we knew nothing about, and the infinite banking concept. I hope you're walking away with a clear understanding of how life insurance can be used to create a self-sustaining general wealth-building machine that can't be taken away. Just like a well-managed forest, this strategy is all about planning for the long term, nurturing growth, and ensuring that every gen benefits from the hard work you put in today. Whether you're setting up policies for the grandbabies, accessing cash value now for major expenses, or building a legacy that bypasses probate, the infinite banking concept, as a part of the save and spend system, offers a powerful way to take control of your financial future.
If you found this episode valuable, don't keep it to yourself. Share it with a friend, a family member, or anyone who's looking to build wealth that lasts. And if you haven't already, hit that subscribe button so you never miss an episode. Thank you so much for tuning in. And remember, wealth isn't just about what you accumulate today. It's about what you leave behind tomorrow. So until next time, this is the Banking Bros podcast. We are signing off. Stay wise, stay healthy, and keep building your legacy.
Now tuned to the Banking Bros. Said we couldn't make it, drink or settle, this the life we chose. Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.